The Brussels Report podcast.
Welcome to a new episode of the Brussels Report podcast. My name is Pieter Cleppe. I'm the editor-in-chief of BrusselsReport.eu. And it's very good to have as my guest Jeppe Kirk Bonde, who's a friend of mine. We know each other quite a long time. And today we're going to discuss investment, which is maybe not the number one focus of Brussels Report, but it's definitely, I think, an important segment when we discuss Eurozone policies, EU policies. I think it's also interesting to try to discuss strategies that people can follow in their day-to-day lives. Last year, I wrote an article on how to protect yourself from ECB monetary debasement, specifically highlighting stocks. And there, I thoroughly went into the world of how much is an average return from the stock market. Some sources said it was 10%, or other sources said it is 7%. But then my guest today, Jeppe, he actually has managed over the last, I think, almost 9 years to secure a 30% average return. So 30, that is 30, which I find enormously impressive. So very welcome, Jeppe.
Thank you very much, Peter.
And maybe I should add that Jeppe has, according to the last information, he has 25,000 copiers on eToro, which is a platform where people can simply invest money and then decide to copy a certain investor. I personally find this a very valuable strategy because most people are able to buy a house and to figure out if a house is a good investment or a good buy. But I mean, at least I'm not capable, I think, to do better than the market when picking stocks. And there's no shame in saying that. This is incredibly complicated, and Jeppe has managed to to have this enormous return over quite a long period. I mean, almost 9 years, and up to 73 million euro of investment is actually copying him. So that's truly quite something. I should also mention, Jeppe, that you don't buy all kinds of obscure companies. You buy multinationals like Amazon, Mega, some others that are perhaps less familiar. So I would say, in terms of risk, of course, it's risky. It's buying stocks, but it's not some kind of suicide mission that you're on if you copy the kind of stocks that you're copying, right?
Yeah. So I have my own risk framework that I use, but also the investment platform eToro has a risk system where different investors get scored on a scale from 1 to 10. So 10 is very risky and 1 is very, very low risk. And then I'm usually on between 4 or 5 in that. And sort of, I don't want to go above 5, certainly. So that sort of puts some limits on it. But I have a level of risk appetite. So I'm always trying to create the portfolio that I believe can give me the highest potential return across different scenarios at my risk appetite. So sometimes that means that there's an opportunity that I think, if I take this opportunity at this level, it will increase our risk in the portfolio a little bit, but it's worth it because this is a great opportunity. And other times I see the opposite. I'm like, this is not going to give us much across most scenarios, but it will reduce the risk so much that it's worthwhile to do that instead. So it's sort of, you're always balancing risk and return effectively when you're working with investments.
Yes, and indeed, from your portfolio, which is visible, you don't have to be, let's say, you don't have to be a client of eToro to see it. Your portfolio is visible for everybody to see. If you just Google Jeppe Kirk Bonde eToro, so that's eToro. Everybody can see it. I also see that you don't often change your positions, maybe a little bit, but a few times a month, right? On average.
Yeah. So the average is 3 trades per week approximately, and that comes in it's not 3 trades every week. It comes more at sometimes I do nothing, and then other times suddenly do a lot. So it's sort of in the same way that you have some weeks in which years happen, and you have some years in which only weeks worth of events happen. So it depends if I'm satisfied with what I have in my portfolio, or if I have even better opportunities, or some stocks I already have that I want to have more in, and then others I want to have less in.
Okay, well, I've been talking for way too long, but I think it's important to properly introduce Jeppe. Maybe one more thing. I mean, investment experts will probably know Peter Lynch of the Magellan investment fund, and in 13 years he secured a return that was like 29%, and this is known as a legendary return. Just another point of comparison to highlight how impressive Jeppe's performance is. I think you're also the most followed. Are you the number one on eToro, the most copied investor? So I would say that's the market speaking, and the market is always right, at least on the long term.
Maybe in the long term. One day. I like to say that the market is medium efficient. Or there's a new Danish book saying it's efficiently inefficient, which of course means that what does efficient mean? If every single photon in the entire universe was taken into account, even then you couldn't necessarily value everything perfectly. So you can never value everything perfectly. But then you could say, if everything costs more or less what it should, then you would say, okay, it's not worthwhile for one extra person to spend a long time to find something cheaper. If you go into a supermarket and there are 30 identical bottles of milk, it might not be worthwhile to spend a lot of time looking for the right one. But if you come into one and they're all from different time periods and different things and are completely different prices, then it's worthwhile to just take a look and be like, wait a minute, which one is actually better here? And so in general, if the market is if I and others take a look at the market and find that there are things that are not priced right, then it's worthwhile to spend a lot of time to analyze it and to see if you can sort of confirm your hypothesis and buy it. But in times where the market could hypothetically be at the case where everything was randomly priced, so a new lemonade stand would cost the same as Apple. If that was the case, then analyzing it would be so worthwhile that basically everybody should just go in and analyze it. But it will sort of, the market over time, find a level where enough people are analyzing it so that the price are more or less fair based on information that we more or less have, and hypotheses that could potentially be true. So it's gonna be at that at different times. So somewhere medium efficient.
Okay. Well, which is great already, I would say. So yeah, I mean, maybe let's finally dive into it and start with my first question. So very simple. Inflation is raging. At least the official CPI statistics are really bad. And if you just leave your money on the bank, you lose a lot. Up to 8% in Belgium, my own country, for example. I mean, to what extent would you say, from let's say a 5-year perspective, is investing your money in the stock market, in like following your strategy, basically? Is that a good strategy to protect yourself and your savings against monetary financing by the European Central Bank and other central banks?
So, I mean, for most people in most time periods, it's good to have a diversified portfolio. For many people, that means, when they're young, investing in education is good, then buying a property is good, and then adding some stocks is good. Historically, bonds was also quite a good asset class, but when you're buying a bond today, the ones you can see traded in the market are at a very low yield. And if inflation's higher than that, then you're basically logging in a negative return. And, if you look at what you can insure yourself against inflation for in the markets and compare that with the bond yield, then the real bond yield you're getting on many bonds is certainly negative. But that's obviously not very attractive. And then with sort of bonds not in favor, they could come back if the interest rates are high. You'll always make a comparison as an investor. If I look at my expected profits and growth from a company that I can invest in, and I see, okay, they're having a nice safe profit margin. They're having good growth, I believe I can make some 8% per year from this, or 20% or 50% or whatever is the case there. I'm gonna always compare that as well with what could I get with a bond from them. If they were offering me 18% from a bond, that even if the company goes bankrupt, I'm gonna get my money before everybody else, I would probably pick the bond. But if they're offering me what's effectively a negative rate on that bond, I'm gonna say, you know what, I don't feel like that's a very good deal I'm getting here.
Yeah.
And then you say, if you're holding cash, then you are not even getting that interest rate. Of course, you don't have the risk that they won't pay you back, but you're still holding something that will be created more of as time goes by, and therefore, if the creation amount in terms of total liquidity supply in the long term is significantly higher than the growth of the total economy. So if you can imagine an economy where there's 10 people, 10 cows, and $10, and then these 10 people, they each think one cow is worth $1. If that economy adds one more person, one more cow, and one more dollar, and they buy one cow per year, a cow will still cost $1. But if suddenly there's $20 in that economy, it's very likely that somehow they'll find a way that each cow should now cost $2 instead of one, just because there's twice the amount of money. And that's sort of the process. So if you're only increasing the economy by 10% or by 1%, but you're increasing the total liquidity supply by more than that, then that pushes for inflation. And all these other factors of short-term squeezes and here and there, and how should we calculate the oil price into inflation and whatnot, that over the very long term won't matter at all. These things sort of disappear away compared to the effect from the total expansion of the money supply.
Yes.
Then when you look at sort of what can central bank directors that want to leave a good legacy for themselves do when they've suddenly experienced too high inflation after handling a severe shock to the global economy. Firstly, there's not an idea that you need to go into deflation. If you want to credibly say we should have 2% inflation in the long term, then inflation was for quite a while only at 1.5%. So then sort of you was banking 0.5% extra every year, sort of saving that up as, we can, to maintain our long-term 2% credibility. Every year we only at 1.5%, we have 0.5% left we can spend some other time. But now we've burned through that, unfortunately. So all the goodwill built up has been burned through. But then, if you have 8% and then 5% and 4% and inflation rates of that magnitude, then you could say, okay, to get the expectation back to 2%, you should have negative, deflation suddenly. But that's not the case. The case is more that you would try to,
not gonna happen.
Try to go down to something like 3%, then maybe 2.7%, 2.5%, and 2%, and then go down to 1.8% and 1.5%, and then sort of if that becomes the general thing that people expect, then they will also believe that it could be 2% long term. Now, of course, there are some definition changes. You've changed the way that inflation is calculated. There's also now a new definition of how a recession used to mean like 2 consecutive quarters of negative GDP growth, but now it just means a longer period of negative overall economic performance. So it's easier to achieve your targets nowadays when you're allowed to change sort of the definition of them. But I think there is and of course then in an economy where everybody's expecting high liquidity increases every year, and where the government is spending as if based off of them being able to get that extra credit from the central banks, in that environment you are pushing out a lot of economic growth that we all experience, and when we don't have that anymore, of course, that's going to leave many businesses less profitable. It's going to leave many people with not getting that raise they were maybe hoping for, and other salespeople not closing that sale they were hoping to get there, and so forth. And that leaves that if you have a company that's making some 5 or 6% return on their capital, then suddenly maybe they'll only be making 3 or 4%. So you factor all that in, but with all those with all that negativity around that inflation, you say, what can you then do with your capital? And there you have to the assets that where you can increase prices quite flexibly. Those ones they're not immune, but there are some times where if you're in a position where it's really difficult for you to negotiate increasing your price, or for you to negotiate your salary as well, then you are the one that will be a bit in trouble, because while others will be increasing their prices, if you aren't able to, then you are the one who's getting you're being bargained a step down. And in terms of like real assets, like the ownership of companies, ownership of properties, ownership of commodities and such, these have generally been quite able to adjust not necessarily in 1 month or in 3 months, but sort of over a few years. Certainly, there are many. I've seen many good pricing strategies in companies based off of you know. You can't write an email out to your customers every day saying we've changed the price. The customers are going to go insane in this way. But you can sort of once in a while change the way you're. There's a whole sort of like series of best practices for how to change your prices, and you follow them certainly within an foreseeable future. Certainly within 3 years, you can sort of have adjusted your prices to accommodate that punch from the extra inflation.
Yes. So let's say you already have your own house or real estate, which I think is a no-brainer as a first investment. Otherwise, you have to rent, and you have your cash cushion. Like, how much of your percentage would you put of your assets would you put in specifically in stocks in that scenario?
So in terms of sort of wealth management for normal people, and then for different classes of
let's say for ordinary people.
Yeah, the thing with for, of course, if you're very rich, then it's easy to sort of keep things at a nice balance, because one property isn't much out of your total portfolio, so you can sort of very much, when you are a normal middle class person, then of course the property is the big chunk, and buying a second property at some point will be another huge step up. So the normal case will simply be that you at some point you buy a property, and then there's a long time where all of your investments will be going into stocks, and only basically when you either have a great opportunity to add a second property, such as buying a beach house or buying something else, then maybe you can jump on that opportunity. But there'll usually be a long while where you can add stocks, and then when you have as many stocks as you have property, then you could contemplate that you'll be adding stocks for a while, but you'll also be eyeing now the second property. And there is for many rich people as well, normal people, there is having both property and stocks in almost 50-50 is a very fine way of having your assets allocated.
Well, 50% is if you have to match, let's say, the number of stocks in terms of value with your real estate. I mean I would say that most people, at least in Europe, maybe it's different in the States, are absolutely underinvested in stocks, right?
Well, so it's a journey to get there effectively. So you'll have many that when you buy a property have zero stocks. And then you get to a point maybe where people have slightly making more. Often you'll have also the first year people have a property, they have lots of extra, they stretch themselves thin to buy the property. Then there's a period of sort of settling in and whatnot. But then after that, suddenly maybe people start seeing some cash flow. Then if they have 4 children, then that'll cost the cash for a while. But they can certainly, once you start having excess cash every month, then you can start building up into stocks, and then you effectively can continue to invest into stocks for a long time. So you don't have to sort of worry about all sorts of other things. You have a long runway now where, if you have excess cash, you can plow some of it into stocks. The other things as well, of course, depending on where you are, you can have insurance, you can invest in your pension fund. And of course, it's become easier now as well to make private investments, but that's usually for people with a lot more money to invest in startups or anything like that. The classical sort of thing that I think where people are over investing is if you have property and you have a lot of property, that's still very fine. But sort of a lot of companies now pitching investments in art and collectibles and NFTs and different cryptos and such. And while individual ones can be fine, the historic average of this whole asset class is negative. So if you look through history, what has been the return of people collecting stamps? My dad, he had lots of stamps. They were very popular back in the day. Now stamps are not so valuable anymore. Some people collected Magic the Gathering cards when I was a kid. Now they've become very valuable, but they might not stay very valuable. And so there are many different ones, and some of them have done well, some have not done well. But if you add them all more or less together, tulips did well in the Netherlands for a while as well, in some 100 years ago. But it's those added together is not a great asset class. So you sort of, I would say for most people, it doesn't make sense to pile a lot into that. Only, a very limited amount into some, maybe one thing that you are even accepting sort of. There is so much passion involved as well. Maybe that you are willing to stake a little bit of your investment in it as well.
And what if, let's say, interest rates go up quite considerably, and let's just assume central banks will do what they have pledged to do, which personally I doubt. I think the consequences may be too big and they may just revert course. But let's just assume that they will actually do what they have said that they will do. I mean, do you think that this would hit real estate prices more than stock prices, or is it too simple to say it like that?
No, I think you can hit them about equally. Effectively, it's not only a question of what will happen to interest rates, of what will happen to that compared to expectations. And expectation is always they will rise certainly some extent, and you have to you know many places if you compare what you're paying for property compared to what you can make in rent or what it costs to build a new property and so forth, and you compare stocks with how much they're growing and how much profit they have and so forth, then they're sort of both reasonable asset classes still. It's not that one of them's completely raised away from the other into a realm of being that you should all yeah. So they're still both very sensible to have, and they're also both sensible to have even when interest rates are potentially a lot higher, except there could come a point where you want to be adding some bonds as well. And in terms of sort of your total risk management, effectively, you're not gonna eat your money. You're not gonna you sort of see that in your life you're gonna live in a house. Okay, you own a house. So then your need for a house is hedged against your ownership of a house. Even if houses double in price, oh no, you need a house. So the cost of acquiring a house has now doubled. That's terrible. But you own a house, so the value of your house has doubled. So actually nothing has happened to you. You might feel very happy that your house went up in value, but also your need for a house went up in cost by 2. So even though people are happy when their house goes up in price, actually they didn't gain anything. The only thing they potentially gained was a bigger tax bill, because when they sell their house, maybe there's a tax on it. So and the same a little bit if the stocks are just going up from inflation. There, oh yes, my stock is worth twice as much. Yeah, but it depends on what you can trade it for. So effectively, if you own stocks in the companies that make the things you need more or less, then you're effectively owning factories that can produce for you the things you need. You have a part share in that. If you own a piece of agriculture in one way or the other, and you need food, and then that hits against your need for food, you're effectively immunized because, oh no, the price of food doubled. Yeah, but also my investments that are capable of producing food have doubled. So so in that way, by having a lot of different assets, you can almost make yourself immune to all of these things. In terms of when they change interest rates so that the value of currencies change a lot, everything else is measured in currency, so it'll seem like everything went up or down in value very significantly. If the dollar is suddenly made much, much stronger, that's very often when you read big stories in the news of like the oil price is hitting a record thing. It's very rarely because of anything to do with oil. It's just because the dollar, has changed a lot in value, and then the oil, when measured in dollars, is changed significantly. But the oil measured against all sorts of other assets has not necessarily changed. And if you're a billionaire and you own an island and a company and a mega yacht and 10 other things, and the price of all of them double, like, it doesn't really matter, because now you can trade a double priced island for a double priced yacht, or you can trade a double priced yacht for a double priced company, but you still own one, and you can trade them just like you could before. So sort of, because they make, of course, if you're willing to have everything in cash just at the right time, that could potentially be good. But because cash on average historically has lost 3% per year due to inflation, and because it's only in very lucky periods here and there that cash has suddenly managed to be really good compared to all other assets, it's very dangerous to have all your assets in cash hoping for hitting that exact nice timing of, yes, I dodged the crisis there, or yes, I dodged that change in central bank policy or something. It's in cash is good for to the extent that you have your own cash management. So you have a need for cash in general, and you might also have it in order to feel comfortable. So everybody should not have to rethink their whole living situation and property situation and stock portfolio because they get a dental bill, or because suddenly they went to a restaurant, and it is very nice to have a little bit of money or credit available for those day-to-day expenses and the likely unforeseen expenses. People don't need to be cash management prepared for everything that could happen, but there is a certain comfort level in having enough cash or credit available for any sort of thing that can likely happen. But then anything beyond that can start to be something one considers. Am I having all of this cash just lying around here that I could potentially need, but it's not likely I will need it? If I need it, of course, then I might have to do the hassle of going in and selling some of my stocks. So I have to do the hassle of something. But if there's a sort of, you have enough to cover likely unforeseen expenses, then anything beyond that can potentially be put to better use. Now, of course, it's also, whenever you're investing in property or stocks or alternative assets, so forth, it's also you're also taking the action of taking on risk. No one's willing to reward you very much, and that's a difficult thing for people to understand, that you're not just that people used to say, I buy this shoe, I get one shoe. But when you buy one stock, it's not like, I give you $100, you give me back 130 next year. No one is willing to give you that deal. In fact, they're willing to give you that deal, but they want your money to protect it. So if you want to give your money and for certainly have something back next year, you're earning a negative interest rate. So there is no one out there who will just take your money and give you back higher next year. But what you can do is you can agree with the business effectively that you take on part of their risk in exchange for cash, and then you might get back more later. So Jeff Bezos, when he was running Amazon for many years, he could not himself take on all of that risk for that expansion. He would have to borrow insane amounts of money and leverage himself so that the tiniest little thing would bankrupt himself. So instead he said, you can buy into Amazon at this price, issuing more shares, allowing others to take risk away from him, but also sharing then in the potential gains from that. And that's what we're being rewarded for as stock market investors. We are putting our capital at risk, and thus we might potentially be rewarded from that, from others that are having a great business idea, a great business that's running and expanding, but they have way too much risk when they're going to build a new factory. So they're relying on us shareholders to come in and say, we are willing to take some of that risk away from you. We want you to build this big new factory, but we don't want one person to have all of that risk. Instead, Jeppe and Pieter and many others are piling in with a little bit of our capital to assume a little bit of the risk. And then if this factory is a good idea, if this new product is a good idea, if this new innovation is a good idea, then we can all be rewarded for that. And that's and effectively, if very few people in this world are willing to put anything at risk in this way, if nobody wants to lend out their land, if nobody wants to work a few hours without getting paid in advance, or to give away their capital without knowing whether you get something soon, then if nobody's willing to do that, then the few people that are willing, they can earn a very high return. Because if there's only a few people willing to put their capital at risk, the people who want to borrow that capital, they need to pay a very high fee for it. And effectively, if you look historically why the return on stocks has been 7% in real return, or 10% in if you include inflation across the West at least, then that is because that most people have this sort of sense that they prefer something that's nice and guaranteed and safe, and not this uncertain outcome.
Absolutely, because in my experience, when I talk, for example, to people about your performance, most people are not interested in the slightest. I don't know. It's like there's some feeling about stocks that it's some kind of a casino, that it's going up, it's going down, and there's no real proper strategies possible. And there's people claiming, which is supposedly backed up by academic literature, that it's impossible to beat the market in a consistent way. That's one of these dogmas some people are pushing. So yeah, what's your view on that? Is that also your experience that there's some kind of a I don't know how to say. So some wariness and or maybe deep misunderstanding about the stock market and buying stocks.
So there is effectively, stocks is as risky as almost everything else in life, but it's a way more visible risk. If you look at people that buy a new Netflix subscription, and they have it, and they get it, and maybe they keep it for 1 month. One person in that 1 month might have watched a lot of shows and really enjoyed it. Another person, he didn't watch much and didn't enjoy it. But they don't get like a number thrown at them saying, you only watched 2 shows, you have lost this much value. If they got that, then they would be very scared of getting a Netflix account. Like, oh no, what if I don't use it enough and don't get my full value? If people buy a new pair of shoes, this might become their favorite pair of shoes. They wore them a lot of times at the best events, and those shoes were actually so valuable to them. But they might also buy a pair of shoes and they only wore them a few times, and then they never got much value out of them. But no one's sending you a notification in your app every day telling you that you didn't use your shoes much and telling you that you lost value on your purchase of those shoes. But that's not the case with stock markets. They are traded every day. Every day you can log into your app and see how they're doing, and you will exactly know, oh no, I bought, I invested in this company, I thought it was great, but now it's trading 20% less than when I bought it, so I've lost 20% of my money. So you are made aware of your failure right then and there, and that's very, very tough. It's nicer to just sort of forget, oh, I purchased something, I didn't use it much, and then you sort of can nicely forget about it, and you didn't think about it there. But actually, the risk is a little bit in the same ballpark as when you're purchasing things. Very many purchases have a highly different potential outcome in value.
Quite, and ironically, I think there's way greater interest in things that are, I would say, gambling, like buying a lot of crypto, for example. I mean, young people today, I think there's a lot more passion in in the crypto market. They're a lot more passionate about that than looking at, I would say, proven, more certain ways to increase your capital, like intelligent stock strategies.
Yeah, and so there's obviously an allure of get rich quick, and that's taken many shapes and form over the over history, and that can be quite unfortunate. But if people have excess capital and they're willing to take a lot of risk, that's very fine. And then you of course gotta find out how can you be rewarded the most on average across scenarios with that risk. So then it's on, there's a very big difference in my crypto aside. If you look at the stock market compared to a casino, there's a huge difference in that in a casino, the averages are against you. Every time you go and play on the roulette, you would say that, oh, but there's I don't forget, there's 36 numbers and then 2 green or something like that. You lose a certain percentage with every roll of the roulette. So then if you do that many, many times, you can start to calculate, oh, if you're losing on average every time, if you do it enough times, you will for sure have lost money. So in the stock market, it can be just as volatile. It might go up a lot or down a lot. But if the average historically has been 7%, and if you have companies that on average earning certain returns on their capital, and then, it could go up or down, but the house is with you. You are on average earning the 7% plus minus your luck. Whereas in the casino, you are earning minus 3.6% or something plus minus your luck. So that's a very important difference. But people might not notice that. Similarly, if you buy a lottery ticket, people don't care whether they have the odds 1 in a million or 1 in a billion times whatever it is. But that's if you think mathematically about it, that is extremely important. Especially if you do it for 30 years, then because then the averages will start to really show themselves.
Absolutely. So then off to a new topic. So what's your view on gold? So I think I'm quite a gold bug, not in the sense that I would pump 100% of my assets into gold, but because I generally believe that, especially as compared to holding euros, that it's not excluded that we have that the Eurozone collapsing. I mean, especially now with interest rates going up again, it's not excluded that we have major, upsets in society. Let's hope that the war in Ukraine is now that this will not expand and everything, of course. But I think that's we should not underestimate that risk. And then buying, I would say, physical gold is not a bad idea, specifically if you look at the last 20 years. I mean, this particular commodity has actually been doing quite all right. In some cases, some comparisons even better than the S&P 500. So what's your view on that? Also knowing that I saw that you have a gold stock or a gold mining stock in your portfolio, which let's say reassures me about it. But please.
Yeah. So, firstly, the problem with gold is that since if you had a gold bar in the Roman Empire and you kept that gold bar, today you still have one gold bar. The gold bar doesn't spawn little baby gold bars. It doesn't multiply into more gold bars, which is different from having a property that you rent out, and thus you make rental income, which you can use to improve the property and eventually buy a new property. So if you owned one property and then operated that property would over time have multiplied into a large property portfolio. If you owned a company, that company kept making profits. That company either paid those profits out as dividends that could be used for other things, or it kept the profits and invested it in making the business bigger, acquiring other businesses, just making more of the same business. That business grows. So over time, a business or a property investment there can grow a lot, but a gold bar more or less stays a gold bar. So that's the unfortunate side of it. The good side is in terms of those of that really core security level. At the most extremes of times, of course, if one person has a gun and one has a gold bar, the person with a gun will have a gold bar and a gun, and that's so in terms of the most risky scenarios, of course, there's security is a whole different sort of matter. But in many scenarios through history, gold has proven its worth as a very testable, unique, has all the good characteristics of what used to be called money. I mean, the definition of money has changed over the years, but gold used to be money. Now gold is a commodity, and what used to be a note that was redeemable in gold, that was a bond, but now that's money. And then And effectively, if you have if it says on a piece of paper in the Danish government's vaults that I own a property, and I have a copy of that, and my bank has a copy of that, then it's very then I get the right to use that property. But my right to use that property, I have to say, it's not just because that piece of paper exists. It's because there's a government, a police department, and other people that accept it, and there are some conventions and norms and all of these things around that make that piece of paper worth a property. Effectively, if without all of that thing, then that piece of paper is not worth a property. And if we have a society where effectively money is just a type of debt, because if I write a piece of paper, you have an island with just two people, and I write a piece of paper that says, Peter, you owe me one favor, and then I have that, and then eventually you do a favor for me, and I give you back the paper, and you say, okay, now it's reversed, you owe me a favor, and then we keep passing this paper back and forth whenever we do each other a favor. Then that piece of paper is just representative of our idea that one of us needs to do the other one a favor, and we have that collectively. When you own a piece of money, you are owed a favor from someone that believes that money has value. And that's just it. So there's no sort of clear distinction where debt and money is different. It's just debt and money. Money is a type of debt, and the thing that proves it can be a piece of paper or a number on a screen or whatever it is. That's just sort of our method of remembering who has it. And in the Easter Islands, you used to have rocks on the bottom. You just had big rocks, and said, if you have a big rock, then you owe me a favor. And then we say, like, now you own the big rock. Then you are the one who has entitlement to a favor for one day when we. So that's sort of an. And gold has been accepted across different cultures, easy to transport, easy to store, doesn't take up too much space and so forth. So for all those reasons, it's been a very good core asset. But then if you compare how much gold you're getting when you're buying one gold bar and paying the money, it's very fine. Now you have your gold bar. Now you got to store it and keep it safe, ensure no one comes and rob you. Maybe you'll sail to a small island and dig it down like a pirate or something. But other than that, there's a lot of problems with that. But if you look at what you can get with a gold mine today, with some gold mines, you have all your gold safely in the ground, mixed in with a lot of rock, and have equipment that can nicely dig it out over time and sell it at the right times based on the prices. So if you look at how much gold you're getting in the ground for a lot of the gold mining companies now, you're getting a lot of gold for very little money. And those companies are digging it out at a very good rate. Then they have the ability, in many cases, to increase the rate at which they dig it out. They also have the ability to make exploration, to get licenses, to get out more gold from other places. You can see with third-party surveys for how much gold there is in the different places. And if you sort of compare what you're paying there, you have companies that are having extremely steady production rate, selling at a very good price at very, very cheap rate, then that's just a much better investment in my view right now. So I can have gold mines or gold, I much prefer gold mines. That didn't have to be the case. The gold bar is, of course, in the worst of cases, safer. There was an old saying that you should have, a certain amount of your money in jewelry on yourself, because then if the worst things happen, you can always just run away, and at least, you might have you can sell your ring to get a ferry ticket or something like that. So that's sort of taking out the most extreme scenarios that I have many thousands of scenarios that
Sure.
that I look at and whatnot, and there are some that are in there, but they're with such a small percentage chance that they don't really matter. But it's still one of those unlikely scenarios one day will happen. So if this one protects against enough of them, effectively, it could potentially be worthwhile.
All right, good. And then other commodities, I mean, especially with the war in Russia, I mean, the EU is going to impose a coal embargo on Russia. It's expected that the next step may be an oil embargo. That's a big step. It may not materialize, but there's a chance. And then least likely, but still a small possibility, is that the European Union imposes a gas embargo on Russia. So I mean, what's your view on investing in oil, coal, gas, perhaps other commodities? Think of nickel, that are also, let's say, heavily present in Russia. I mean, what's not present in Russia? So many commodities, and maybe even beyond the specific Russia situation with inflation numbers, clear, let's say, energy prices going through the roof already before Putin's invasion. I mean, how do you play on that?
I mean, for societies as a whole, war is a lose-lose outcome, right? But there can be cases where individuals are willing to say, yes, we lose, but you lose more, and therefore we are willing to take this hit. And that's of course very unfortunate that it's come to this. But in terms of without going militarily against Russia, doing everything else that we can is sort of some of these steps make very good sense. But then of course there's a challenge that it can be sort of unfair exactly who it hits. So you have of course some companies where they will get very 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 brutally hit from this, and that if you have say now we are, because we are willing to do this and that, it could suddenly cause that not as much food is shipped to certain countries or something like that. Then they are the ones that are getting randomly hit. So there needs to be also some kind of mechanism where we say, okay, collectively we want to do this, so we are willing to compensate the ones that are getting extra hit from this. And if we do it that way, then we can potentially overall as a European economy take a big punch and say, okay, we don't want any individual particular country in Europe or any individual companies like that to take this massive punch, but collectively we can certainly sustain this, and then we just got to compensate exactly where that punch hits, and then we should be able to take it. And then I think there is sort of a timeline question of is it better to sort of take a very big hit early on, or is it better because how much does that sort of discourage Putin and that kind of behavior versus how much does it damage us? Could we do almost as much discouragement for half the price if we wait a little bit? That can sort of be a little argument for that, where sort of, but you could also just be brutal and say, you know what, actually give us the big punch here, and then we'll deal with that in terms of some of these things.
And also my question was also meant to, like, in terms of investment, how do you let's say defend yourself against that? I mean, is it time to buy some gas stocks because some part of the gas supply will be taken off the market if this thing escalates, or the same with oil stocks and other things?
Well, firstly, event-based investing is generally not a very good strategy. It's if you have an event that's being analyzed by the media, you already got to, how much, if you want to say like you're being rewarded in the markets by contributing unique new analysis of things, finding out here are 20 tomatoes, they all look the same to everybody, but you are making a unique analysis of their specific property and identifying that these 5 of the tomatoes are actually slightly better. You're buying a used car. Maybe everybody sees the same thing, but you are an expert in tires, and you find that these ones have slightly better tires, and you're getting a slightly better value, even though they cost this and this is a difference. You can tell something that you come in with your unique analysis, and you're getting rewarded for that. So you're getting the average result plus a reward for your extra good analysis. But if you have an event that the entire news media is focused on, all politicians, all departments of government, and all the major investment banks and everybody, the chance that this is under-analyzed is extremely small. So you are adding your analysis on top of all of this existing framework of analysis. So it's very unlikely that you can make money from it, but you're going to be it's just like there can be a very large investment bank that finds value in doing it because they has a marketing value. So by developing a lot of expertise in this, they can say something, and then in addition, they can make a little bit of money to recoup a little bit of the value spent on conducting all this analysis work. But it becomes low margin business. So you're making, you have to compare. If you are hiring 100 people to sit and work day and night on analyzing something, and this drives your return on, say, even if you're a very big investment fund with a $1 trillion, and this drives your return up by 0.0 something percent or something, then you might not have made the money back. If you're doing this event after event after event, always a new thing. Now you have to be an expert in this. Now you have to be an expert in that. You might not over the long period actually end up making an excess return on that. But in general, you can say, in the same way that you want your portfolio to have sort of things that are hedged against different things, some of these assets can make sense in that regard. And so there can be a case where you say, if you have oil and gas, and a lot of companies in your portfolio need oil and gas, then you, by having your own oil and gas, are protected against price rises, and vice versa, you already protect against price decreases from it. So then that can sort of safeguard yourself. Then there can be some of them that are more in terms of having an ethical portfolio. People may want to say that they should not have more oil and gas than average compared to having renewable energy, for instance. So you sort of, if not having only renewable energy, you're just pushing a little bit in the right direction on this. And similar with other things, where you could say, if you a lot of people have historically not wanted to invest in defense companies, but of course you cannot have military defending democracies with making their own weapons out of nothing. There's a need to
Absolutely.
produce some of these things, and so you'll have some companies that are doing some things that are sort of not nice but necessary, but you have others that are doing things that are not nice and also not necessary. And so these can sort of be, I would say, even if they have a temporary sort of a moment, last moment in the sun or something, they still might not be something that should really belong in a good ethical portfolio.
Well, yeah, and very good points from which I sort of take away that if something is heavily analyzed, the chances are that the market price will be, let's say, more correct than in other cases. But sort of, I mean, there are some political developments I think that we see now, which is perhaps incorrectly described as reversing globalization, in the sense that we may end up a situation where trade with countries outside of the West, or with countries that are not partners of the West, notably China and Russia, will become a lot more complex and burdened with all kinds of hurdles, justified or not. So I mean, I see you have some Chinese stocks, for example. If I'm not mistaken, you were invested in Novatech, right? Russian stock. I think you have what's it, Ferex or something. Ferex, a mining company, right? In Ukraine, which I'm sure has suffered some damage. Like how do you adjust for that? Because this is not something visible on the accounts of companies. That may be very fine in principle, but then politics weighs in, whether you like it or not. So you sort of have to adjust for that.
Well, so firstly, in my time in investments, I've seen many sort of come and make a clear statement saying like, I think this is going to happen. They put all their money on that, and then they're right. But then 3 years later, overall they are significantly down because they weren't right consistently with that. And so it's not so. It's more of an art to be able to say, yeah, these are both potential scenarios. And this maybe I put 70% likelihood on that and 30% on that. And if this becomes the case, I think it's valued like this. If this becomes the case, it's valued like that. So when I average that together, saying 70% likely of this thing happening, and in that case, this would be valued that, overall, I then think these assets are worth that much. And then that might mean that there are some assets that are good in China. It might be there's some assets that are good in the US. The ones that are good in China might be getting a lot of their value from the good scenarios where there's continued trade, or they might be very good because of a scenario where there's no continued trade, but China ends up winning everything and the whole world becomes, China dominated. So it's based off of those scenarios where that one becomes good. But then you say that asset isn't good because you believe that's the most likely scenario, because you're like, no, that asset is good. If an asset is great, of course, if it could be amazing across all scenarios. But most assets will be more good in some scenarios and less good in other scenarios. And then sort of when you look at all those scenarios and then evaluate the assets, then there'll be some that sort of like, yeah, this is good in that case. But if that happens, it's bad, but it's not as bad as it could be. It's only this bad. So and then when you weigh that out, you get to sort of some valuations. And then with some of these things, for instance, as Westerners investing in China, you'll also see that you're getting some lower prices compared to the profitability and growth and other metrics. So then sort of like, you're getting this discount. Yeah, but there's also this risk that, when I was investing in that Russian company as well, I put in a high percentage chance that it would one day be nationalized, saying, there could be a conflict, the Russians are going to... Sure. Then it was sort of nationalized in a different way, in a way of saying, like, we're no longer allowed to trade it from here, and only Chinese investors can now sort of buy them in Russia. So there's been sort of that, and a different sort of way of it. And it could change, in 10 years, maybe it'll come back to the global market or something, but there's and that's sort of same... If there is an overload of negative potential, it'll be a discount. But this discount can also be too great because people are very risk averse and they're very story risk averse. So if people hear, this stock has a big red flag in it, there's something very dangerous about it, this could go very wrong, then people think I must not have this at all in my portfolio. But that's not necessarily the case. If there's a 15% chance of something very bad happening, but there's a 20% chance of something very good happening, and then you multiply the numbers, you're like, hey, actually, take that risk. It's not your only stock. It's not your only investment necessarily. If you have lots of different stocks, it's fine that one of them has a potential very bad outcome. That's fine. You don't need every. If you have one Tesla once in a while and one Nvidia once in a while and so forth, then it's okay that there's also once in a while a Russian company that didn't pan out, or several Chinese companies that didn't work out, and so forth. That's the nature of a diversified portfolio.
Well, okay, great. And then actually my last question, which is definitely not well, which is probably the most important one, is about tech. I mean, and AI. In your portfolio, you've been particularly successful on that front. I remember you've been invested in Tesla for a very long time. You also managed to sell it or to sell part of it at the right. At the right moment. I've been listening to your explanations why you bought Tesla, and if I understood well, it's because not so much you're so keen on electric cars, but because of the technological value of Tesla with all its data that it has and its potential for self-driving. Correct me if I'm wrong, but I understood that was sort of your decision to buy Tesla, which is I think very refreshing to hear, because in the public discourse, you hear that Tesla is a valuable company because they have electric cars, and you seem to take a different view on that. So my question is, are we at the sort of the end of the growth cycle in tech stocks and great developments, or are we at the very very beginning, and is now actually the time to look a lot more closer to that and and to pay a lot more attention to the great opportunities in tech.
Yeah, for individual companies, I think there are still extraordinary futures, and then for others, it could go very wrong very quickly. As obviously we have not seen at all the final outcomes of AI in our lives. This is really only just starting. So that's in terms of the value creation that can come from this. There's amazing new products and services that can be created that can make our lives a lot easier. And the companies that are making these, they can certainly push this quite far. But then it's a question of how much profit can they be getting from it. Certainly, some of these big tech companies, when I started investing in them, they were very high growth companies, but not that profitable yet. And they were at a very low price because people didn't value growth yet. Now they're at a much higher price, but they have become extremely profitable companies. So compared to what you're receiving, what they're creating in cash flow every year, compared to what you're paying, is still very little. So in that front, there's still a lot of room to grow, and that's just based on how much profits they're making. Their profits are growing significantly as well, and they're very very strong growth with some of these big ones. So they've sort of they are different. They are different idea. You used to be buying like a one Coca-Cola for $1, but now you're buying like a swimming pool full of cola for a whole different price. But it's the what you're paying for what you're getting is still a very good deal in many of them. Then you have other stuff coming out, new regulation that, depending on exactly how it's shaped, that can determine how the market is shaped, what direction these companies can go in, which things they should focus on. Are you going to have more of applying more money into content to give everybody more viewing experiences, and if they do that and it becomes too expensive, that could sort of start to eat into these positive cash flows. So you're suddenly seeing like, wow, we are paying more, but they're also giving us so much more, and that's actually ending up costing the shareholders, so they're not getting that final thing they thought they were going to get. And it's some things that are very technologically advanced for a while become seemingly technologically simple in the long run. So you can often have something where it's like there are very few engineers who can figure this out, and the university professors aren't teaching it the way that the engineers are really working with it in real life and so forth. But then over time, someone teaches someone else, and that person, he becomes a professor, and he starts writing some papers about it. Then those students figure it out, and then a textbook is written about it. Everybody can read the textbook. Then a popular science book is written that people can just, and then suddenly there's some YouTube videos. And over time, it just becomes that those things that were, you could reach the point where it's like, oh, Google search engine, I can just program one like that. That's very quick. You can reach sort of that level, then of course there can be hyper competition and no profits left. But if you can have this point where you say like, oh, you have companies that have an amazing source of data and they can sort of protect it in certain ways, or they can offer some services because of a critical mass of users, or because of for other kinds of log-in effects, then you can still maintain a very high profit margin and avoid it all being competed away for some of these companies. And that I think in terms of some of those things, like the actual self-driving car, the computer that can see and analyze what it sees and act based off of it, the Google's like AlphaFold in biology taken to the extreme. There are some of these sort of things where we can.
What's that? Sorry, Google's.
Well,
Alpha?
if you look at they effectively, since Google bought the AI company DeepMind, they've been able to churn out a lot of very cool tools that whenever you see some breakthrough in AI in one place or the other, very often at the bottom you'll see that one of Google's tools was used for this. And that's sort of, and that sort of underlying basis of Google's AI can be used for many, many different things that can create immense value, and Google will likely capture a big part of that value, and we as consumers will capture part of that value. And that's sort of, that's the best case for that. Shareholders will win, consumers will win, and employees at Google will win.
And actually, specifically on Google, like what we've seen is that incumbents tend to be sort of taken over at some point, or let's say when you had IBM, they were dominant for a while. Then Microsoft was dominant, just when specifically antitrust regulators were saying, "Oh, we have to break them up; they're too big." I mean, that they were already over their top. Because they were so big, they were not so agile anymore. I mean, what makes you so certain that it's not going to be some startup that's now a startup that's going to be the new Google in 10 years? Or is that because for AI you need a lot of data or?
Well, I mean, I've tried to sort of go through all the historical similar cases, the big revolutions we've had historically. So, when oil was invented, you had all the tycoons of America. When they started transporting things with railroad, you had the railroad barons. And then you had lots of sort of, also had when the telegraph was invented, then you had all the privacy issues. Should people be listening in on a lot of people's telegraphs they're sending? And, all of these things have sort of been dealt with in different ways before. And just because, when you had the oil industry being established, there was the initial companies, they grew a lot, but the ones that became very, very big and stayed there, they stayed there for 100 years and stayed good investments for 100 years. So just because you become huge doesn't mean that suddenly a little guy is going to overtake you. Like that happens when there is a lot of disruption, but when the disruptions happened, you can stay in that good position for a long, long time. But then add to that a company like Meta Platforms with Mark Zuckerberg and many others, they are much more aware of this idea that you can get disrupted. That used to not be like even a word. There was just this idea: if you're big, you want, then you are untouchable. And that certainly went away effectively. I guess the first big business case were with the Kodak, when sort of they lost with the digital cameras. They had the old cameras, and then suddenly came digital cameras and killed them. And that made everybody sort of, holy moly, you can a new product can come with a new technology and make yours obsolete. And I mean, I remember in the consulting in the telecoms industry, right back when people were saying like they had no fear of Netflix. This wouldn't this wouldn't really do anything, right? And that was and then the sort of but it's very small. It's just it's growing a lot, but it's still very small. People don't look at it that way now. And also you had this idea back then that but if it becomes big, you can just buy it. So you had the idea, we are a very big company. Even if a small company is very, very good in there, we can just buy them. You can't just buy them now. A small company that has something that's gonna knock you out can suddenly have a multi-billion-dollar valuation. They can suddenly IPO. Suddenly they're growing. Suddenly they're buying you. So you sort of so there is awareness of that and reaction towards that. And that's sort of what they need to do, but it can happen fast, and especially as more and more as it potentially becomes easier to launch new technology products fast.
All right. Well, thank you, Jeppe Kirk Bonde, for this fascinating conversation. I thought that was really really instructive. So thank you very much, and we'll stay in touch.
Definitely. Thank you.
The Brussels Report podcast.